Morning everybody, thank you for joining us and welcome to our webinar which is entitled Collections Processes in Common Export Markets. So we're going to be covering off France, Italy, Spain as a focus for the collections and legal processes. We're joined today by Lauren Carter, who's Operations Director of Moreton Smith, and also by Hal Griffiths and Fergal Tierney of Credit Mundi. The first part of the presentation is really focusing on what Moreton Smith do, and we're trying to sort of impart our knowledge of working with international markets for collection of debt. And Lauren's got a great deal of experience there. She's been with Moreton Smith now for over 12 years and set up the outsourced department for Moreton Smith. She led the charge in Moreton Smith attaining the Quality in Credit Management standard from the Institute of Credit Management, and is a fellow of the Chartered Institute of Credit Management. She also sits on the CICM Technical Committee. Lauren's a regular speaker at conferences and industry events, including the CICM Turner Lecture, and is published in the trade press. Prior to joining Moreton Smith, she was credit manager at Penton Media and Smith & Nephew. Just before we start Lauren's slides, if I can let you all know, there is a section in the dialogue, into the GoToWebinar dialogue, for you to engage with us, to ask any questions. There will be time for questions at the end of the presentation, so if you think of any on the way, on the journey, then by all means get those across to us. As far as poll questions go, we're going to have 2 or 3 polls throughout the session, and if you can try and join in with those, that would be great. It'd be good to have your feedback as well. Thanks very much. So just moving forward. Lauren, over to you, I think.
Thank you very much, Adam. Good morning, everybody, and I hope that you can hear me. As Adam said, we're going to be looking specifically at France and Spain and Italy this morning. The reason for that is that they are the most common countries that our clients are dealing with, the countries that we get most volume of debt in. And we're going to look at certain specific questions, and we will deal with each country as we go through. So to start off with, just looking at late payment interest. Now, across Europe, creditors have the right to recover late payment interest from their debtors. The way that that is operationalised in each country can differ. Within these 3 countries, actually, it is similar, in that each of these 3 countries uses the European Central Bank base rate, and they had a rate change in 2013. So prior to that, it was the base rate plus 7%, and that was the statutory interest rate that you can recover from your debtors. Since 2013, the rate has increased to 8%, and that's brought it more in line with the rate that we use here in the UK. If you have an alternative contractual interest rate, you can use that instead if it's more preferable to you. As I said, it's similar in Spain, and they operationalise in a similar way, and it's also similar in Italy. In Italy, they are a little more strict about contractual interest rates, in that it has to be specifically written into your contractual terms and signed prior to trading. So you may have heard that here in the UK we have something called the Battle of the Forms, which suggests that if your customer has terms of supply and you have terms of sale, whichever set of terms and conditions lands on the other side last is the terms that are in practice. In Italy, they wouldn't accept that. It needs to be signed and stamped in advance of trading. So no post-contractual terms allowed, no terms on the back of your invoice, they won't be credited. Moving on, the next piece we're going to look at, limitation periods. So you'll be aware that in each country there is a period of time for which your debt is valid for, beyond which your debt is no longer legally enforceable. As an example, here in the UK it's 6 years, and in Scotland it's 5 years. In France, the limit for commercial claims is 10 years, so they're more generous than we are here. However, with consumer claims, it's 2 years. So if you're selling direct B2C, you need to be aware of that. And as is the case with all of these countries, if you have a written admission of debt from your debtor, that is the period of time that the limitation period starts from. In absence of that, it starts from the point where you deliver your goods or provide your services. In Spain, the limitation period is current 5 years, and that was reduced just last year. Prior to that, it was 10 years. So it's possible that you can have debts from 2014 that will be valid for longer than your 2015 debts. In Italy, the limitation period for commercial claims is 10 years. So you can see that in all three of these countries, they have generous limitation periods. It's unlikely that you're going to get caught out. Moving on, power of attorney. So very often at the debt collection stage, a power of attorney is not going to be needed. When you come to appoint a lawyer to take court action, some countries need a power of attorney, and it's worth knowing this in advance, not least of all because sometimes the paperwork requirement can be quite tricky and time-consuming. So it's worth considering this at the point that you're making your decision whether to litigate against your debtor. In France, you do need a power of attorney to start court action. However, it only needs to be signed and stamped and doesn't need to be notarized. Usually it's sufficient for it to be signed and stamped by any manager within the company. So if you're a credit manager, you'd be able to sign that yourself. And if you can apply a company stamp to that, that will be adequate and that would be accepted. Spain has slightly trickier requirements in that your power of attorney must be signed by a director of the company, and it must be notarized and legalized. So that means that that director of the company has to take their passport and visit a notary. And this requirement can sometimes be tricky for some creditors to arrange that. On the plus side, you can have a generalized power of attorney, and what that means is that the document empowers the law firm to represent you on all matters. So once you've got the power of attorney signed, it's then valid for every debt case you want to proceed against. So you only have to do it once, which is helpful. In Italy, the paperwork requirements are always more stringent. So you need a power of attorney and it must be notarized, and also it needs to be specific to the case. So this means that you need to do an additional one for every debt case that you want to pursue. It can make it a bit tricky to pursue debt cases there. Moving on. So now that we've covered those questions, we're going to look at options available to creditors. So the first one is retention of title. And this is quite a common thing for creditors to use when they're supplying goods to their customers. In France, a retention of title is legally recognised. Your goods must be uniquely identifiable. So this means that if your customer is holding goods in their warehouse, if you sell branded goods, anything that can be recognised as individually yours, you're able to reclaim it. If you sell widgets and they look exactly the same as your competitors' widgets, then it's difficult for you to assert that those goods are most definitely yours, and it's difficult for you to reclaim them. The other point to note is that, similar to the way that these things work here in the UK, once those goods have been sold on to a third party, your ability to enforce your retention of title clause ends. In Spain, again, the retention of title is permissible and your goods must be uniquely identifiable. And unlike here, you are allowed to have a contractual clause in your contract that specifies damages should the goods no longer be available for you to recover. In Italy, again, retention of title is permissible, and as we discussed earlier, post-contractual terms are not sufficient for you to be able to insert that retention of title clause into your contract. So it needs to be specified in writing in your terms at the start of trading.
We're just going to run, just before we move on to getting judgment, just going to run a quick poll to understand how many of you are currently litigating in France, Italy or Spain. So if we could just get some participation from the audience and just try and select one that most applies to you. We'll give it a few seconds for people to respond. Okay, we're at 82% people have responded, so let's go with that then. Okay, so yes, so it applies to half of the audience, and probably the majority of the rest are thinking that they might have a future need to do it. So so that's good. Hopefully the next section will be of particular interest to you then.
Yes, exactly. Thank you, Adam. I think that's interesting. Hopefully that means that what we're talking about is relevant for the vast majority of you, and hopefully we'll be able to provide you with some useful information that will help. So moving on to getting judgment. Processes, broadly speaking, are the same in different jurisdictions around the world. Very often there's different terminology, different fee structures, different rights of audience. These things differ. But on the whole, if you're working with a representative who can guide you through the process, you shouldn't come unstuck. Looking at France, it takes around about 6 to 12 months to get a judgment if your case is undefended. If it's defended, they have a process of a series of court hearings to deal with the defence, and your defended action can take from 1 to 2 years. In the UK, you may be familiar that our court fees increase with the size of the debt. In France, the court fees are fixed for each hearing, so your court action will cost you more depending on the number of hearings that's required. And that, generally speaking, is dictated by how complex the defence is. Once you have a judgment, enforcement is typically either via bailiffs who are appointed by the court or via insolvency proceedings. In Spain, court action there is a little slower. A time frame for a typical judgment might be 6 to 18 months. And if your case is defended, you could be looking at 3 to 4 years. Enforcement, again, is through court agents, typically similar to bailiffs, and they have the ability to do various types of enforcement, such as goods, attachment of earnings, and so on. But it's organised centrally through the court system. In Italy, time frame of perhaps up to 6 months for a standard judgment. And I think with Italy, it's defended cases that can be tricky. It can take up to 5 years to achieve a judgment if your case is defended. It's also worth noting that if your case is defended, it's harder for you to withdraw. So here in the UK, if you receive a defence that you don't want to respond to, you could simply file a notice of discontinuance. In Italy, that procedure isn't available, and you can become locked in a defended case. And so with those, it's slightly tricky. There are certain considerations that we need to think of before we start our action. As with here in the UK, the costs increase with the value of the debt, and enforcement is typically via court bailiff. Moving on to look at insolvency proceedings. I don't know how many of you use those here in the UK, but it's a very effective way of recovering debt. So we're just going to look quickly at whether this is available in these other 3 countries. In France, it takes around 6 months to issue insolvency proceedings, and the costs of that action vary with the value of the debt. It's also worth noting that if your debtor liquidates and you're not the one pressing for the liquidation, you have only a 2-month time limit to register your debt with the liquidator. We can do that for you, and a POA is required if you want your agent to do your proof of debt on your behalf. In Spain, insolvency proceedings, once again, it's more complicated there. You will need to have a lawyer and a barrister. You will need a notarized power of attorney, and it can be expensive. So you can see, because it's a more complicated process there, it's usually not financially viable to proceed down that route as a method of debt recovery. In Italy, insolvency is available, but with a minimum debt value of €30,000, it's generally only considered for certain types of debt recovery. Again, the costs increase with debt value, and you can be looking at between 2 and 4 years. There's a fairly significant commitment for you as a creditor. You also have to have a judgment and have to have attempted enforcement before you can commence insolvency proceedings. This means that we don't see much of insolvency as a debt recovery procedure in Italy. I think, Adam, do we have a question about that?
So, well, yeah, we discussed we had one submitted earlier about whether or not, or what's the best way to proceed against a group of companies in multiple jurisdictions.
Oh, right, yes, okay. That's an interesting idea. When you have a group of companies, they can quite typically be spread around Europe, rather than being operating as one legal entity registered in one country. They're often different legal entities registered in each separate country, and they may have a head office. I know we had an interesting case along these lines a couple of years ago, where we had a client who had provided media booking services for a group of companies that were spread around Europe, and they were owed around, I think, €4 million across 13 different countries. Now, you can understand that 13 different legal actions requires a lot of commitment, time and expense. What we were able to do is to bring insolvency action against that business here in the UK by demonstrating that their head office had control over each of the individual companies around Europe. So the insolvency legislation here in England is much more creditor friendly in terms of using it as a debt recovery process than it is in other countries. And so if you're able to demonstrate that your debtor has what they call a centre of main interest, essentially if it's making its decisions from here, if it holds its main assets here, if you can demonstrate that it's actually based here, then you can proceed against that one entity for the entire group debts. And we were able to recover that debtor, that money for that client from that debtor, using just one legal action here in London, which was very successful for us.
There is one other question, Lauren, along a similar line.
Yeah.
Well, basically it's, do we often see companies adopting other jurisdictions for contract purposes? Which I guess relates, to whether or not, is it terms and conditions, I guess?
Yes.
Okay.
So with our clients, we see a variety of jurisdictional clauses. Some will specify jurisdiction in their home country, wherever that is, and others will have no jurisdiction specified or something more generalised. What we find is that on the whole, it is cheaper and faster for you to issue court action against your debtor in their home country. And so, generally speaking, from a debt recovery point of view, it's easier if you don't have, if you don't limit yourself to one country in your jurisdictional clause. The aside from that is that, of course, a lot of businesses do want to specify which law applies to the contract because it minimises other risks in the contract, all sorts of operational risks and other considerations that the lawyers obviously need to consider and protect against. So it's not just debt recovery that matters. But there are certainly issues to be considered when deciding what to put as your jurisdictional clause.
Okay, great stuff. Thank you.
So moving on to hot tips. So we asked the lawyers that we work with for some hot tips that they would give to creditors. In France, pre-action reports. So we often will get a report on the debtor prior to court action, and that can provide a full asset check and the current status of the company. The other thing to be aware of is that all of the court system and some businesses will close during the month of August. So it's worth being aware of that when we get to this time of the year and pressing the button on things now before things close down. In Spain, similar system applies. The courts are also closed in August. Most of the lawyers and businesses are still contactable, but your legal cases won't progress during that time. The other thing that is interesting to note, in Spain, directors remain personally liable for company debt, so they don't have that protection of limited liability in the way that we do here in the UK. And in Italy, again, an extensive number of searches and reports available, including site visits, bank account checks and employment traces. You have to have a judgment before you can apply for those types of checks. But they can be very helpful to the creditor, particularly the pre-judgment checks, because given that court action in Italy can be slow and expensive, it's worth knowing that your debtor has the asset before you commence action. And again, the court system closes in August, something to be aware of. Fast-track procedures. So as part of EU legislation, each jurisdiction has to have some type of fast-track procedure available to creditors. How that's operationalised differs between countries. Here in the UK, you may have heard of the small claims procedure, so we allow a faster legal procedure for debts below a certain value. In France, they do it differently. They decide that the fast track is available for undisputed debt. So it doesn't matter what size your debt is, but you need to have full documentation to demonstrate that that debt is due. So you will need to have a contract, an invoice, perhaps a POD if you're delivering goods, something else that demonstrates that the service has been provided if you're not delivering goods. And once you have all of your documentation available, you simply go to the court, present that documentation, and they can provide you with a bit like a summary judgment, really, and that takes just 2 to 3 months. As part of that process, the debtor does have the option to dispute, and if that happens, your case will kick out of that fast-track procedure and go back into the usual court procedure. There's fixed costs available on this, so you get some certainty as to what it's going to cost you. So it's very helpful for a fast-track procedure for undisputed debts. It's good to know for credit managers. In Spain, similar to the way it works in the UK, they have a fast-track procedure for small value debts. I believe that the limit is currently €3,000. So a much smaller tranche of debt than we have here in the UK. Again, the costs vary with the value of the debt, and it still may take you 8 to 12 months, so not significantly quicker. In Italy, they have a very handy procedure that we like to use a lot for bounce checks. So provided that your check bounced less than 6 months ago, that's taken from the date of the check, you can apply to the court and you can get an enforceable court order very quickly, around about 2 months. And given that Italy is quite a slow and expensive jurisdiction, that's a very useful procedure for us to know about.
Okay, that's great. Thank you. Thanks very much, Lauren. Going to move on now to a look at some country risk profiles in France, Italy and Spain. I guess now's the time to introduce our guests from Credit Mundi. We're joined by Fergal Tierney of Credit Mundi. Fergal was a broker at Aon in 1995 for a few years, spent 11 years in management roles at COFAS, and is currently branch director for Credit Mundi in the UK, and also by Howell Griffiths, who is a senior underwriter in the credit insurance market, working in both the domestic and export sectors for the past 17 years. Just a little bit more generally on Credit Mundi, founded in 1921, the world's second credit insurer after the United Kingdom. It was just after the First World War that the Belgian government founded the organisation in an effort to ensure political risks and revive the export markets. Their particular specialism is in the emerging markets. So who's going to take us through these next slides on country risk?
Okay, I'll let Hal take that one, and I will sit back for the questions.
Okay. Hal?
Yeah, well, economic growth in France, as we can see from the slide here, is projected to reach 4.5% next year, thanks to lower energy prices. Obviously, we're all aware of the fact that the dollar has plunged, and oil prices have plunged, and therefore it'll make, generally speaking, energy costs a lot cheaper, and employment will increase as a consequence of this. Inflation is pretty much under control in France. Interestingly enough, one of the consequences of Brexit is probably going to be a narrowing in the gap between France and the UK. The UK is the 6th largest economy in the world, I think, at the moment, and France is the 7th, and the spread between them is currently approximately 10%. Now, we may well see that fall to somewhere more in the region of about 5% over the next 2 or 3 years, maybe even closer than that. There may be a projection that France might even overtake the UK by about 2020, but this is all a supposition, of course. If we can just move on to the next slide. Yeah, the Spanish economy has shown some considerable recovery and and is motoring along at the moment. But of course, we have to take into consideration that it was starting from a pretty low base in the first place. It fell. I wouldn't go so far as say the Irish economy, for example, but it was in a pretty poor state of affairs. Its public debt is obviously quite high. Unemployment is sluggishly high, and they can't seem to be able to get that down at all. There are issues internally, politically, with regards Catalonia and the status of Catalonia within Spain. Catalonia is, in many respects, the driving force behind the Spanish economy. That's where a lot of the industry has traditionally resided there in the northern sort of Basque Country sort of area. But Catalonia, there's a distinctly strong independence movement there. But what's going to come, and which is quite interesting from a UK perspective, of course, with the Scottish, where we can compare with the situation in Scotland. Catalonia probably has a stronger national identity in many respects in terms of it has its own language, and also it feels it is subsidising in many respects many of the poorer parts of Spain. So there's a considerable amount of resentment there. So if we can move on to Italy. Italy's growth is very, very sluggish, and they have significant structural issues, and they've got in quite significant issues with regards their banking sector. The banking sector in Italy is seriously under pressure. It's mainly in terms of profitability as opposed to solvency, actually, which is quite interesting. And there's a move to try and merge some of the stronger banks with some of the weaker banks. Now, whether that can actually occur is a moot point. It's something that we will have to sort of wait and see in that respect, but certainly there is a potential for a banking crisis in Italy, and the sort of contagion that will obviously cause for markets, especially in nearby France, again across the water in Spain, and even going the other way into the Balkans. But generally speaking, the Italian economy is not in such great shapes.
Right. Thoughts on, if you don't mind, Hal, on the impact of the UK losing its AAA rating?
Well, that's a very interesting question, actually. Following sort of Brexit, S&P was the last of the big three, Fitch, S&P, and Moody's, to sacrifice effectively the UK's AAA rating. The others also caused a small downgrade. Now, the rationale for this move was the fact that they believe that UK growth rate will fall as a result of Brexit, and also that government debt will increase quicker than anticipated, and they reckon it's going to reach over 90% of GDP by next year. Now, aside from the damage to national pride, in theory, a lower credit rating should result in high borrowing costs. But of course, in today's crazy world, that doesn't appear to have happened, as yields on government debt have actually narrowed. Now, it's really difficult to pin down exactly why that has occurred, but it might be just because of the simple fact that a AAA rating is not quite what it used to be in the past. There's only 12 countries in the world that have actually got this rating, and they include quite buoyant but relatively small economies of like Liechtenstein, Luxembourg, Singapore, and Hong Kong. And the fact that the US itself does not have a AAA rating probably helps. Now, what the long-term prognosis is, however, that's difficult to ascertain. All three agencies are giving a negative outlook, and therefore I think we can expect further downgrades in future. Now, only when this really occurs will we see an increase in borrowing costs, and that will have a knock-on effect and hit us all in the pocket through higher interest costs. But that's further down the line. Now, whether that actually does occur, who knows? But I think we can definitely see the prognosis is that we're going to see further downgrades. But the one thing that we can say with a degree of certainty is that I think it's a lot easier to get a downgrade than it is to get an upgrade in this world.
Okay. Before we move on to the Brexit impact, just going to run a quick poll for the audience. So we'll bring that now. So really it's to get a feeling for those of you who are dealing with customers abroad, your confidence levels. Firstly, with trading with customers in Europe and North America. So 1 being the least confident, 5 being the most confident. How confident do you feel about trading with customers in Europe and North America? If you could have your responses, that would be great. Just over half of you voted. Okay, just a few more seconds. Okay, we'll finish it there. So, how confident? Right. So so that's interesting. Let's keep those in mind when we run the next one. And I guess you know the score. You know what we're going to ask. What about those countries outside of Europe and North America? So we struggled about how to define those, and I guess when you talk about, we're trying to get to emerging markets here, whether that be newly emerging markets or some of the more established, but not exactly the rich countries as you'd call them. But your interpretation of those, if we can get your answers. 60%,
Yeah.
67 have voted. Okay, 73% have voted. Let's close it there. So, well, guys, what are your thoughts on that?
How can you see the poll? Yeah, I can't see the poll here. No.
Oh, okay, yeah, that's quite interesting actually. The poll, generally speaking, appears quite neutral actually, and there's quite a lot. So the neutral, there's quite a lot of confidence out there, with only some 9% of respondents not being that confident about their feelings outside of Europe or North America, i.e. in the developing markets. So there are obviously a lot of people out there who feel confident that the future obviously it looks quite rosy in the developing world.
I suppose it's difficult for us to define in that question exactly who we're talking about. It could be the BRIC countries where things are slightly more established. I suppose with the exception of Brazil, which might be an exception to the rule, but or whether we're trying to talk, whether we're talking about some of the real newly emerging markets. But moving on, how do you guys protect clients in export markets?
Hi, Fergal here. How we protect clients in export markets, pardon me, is purely we're able to offer a credit insurance policy. And what that allows is a policyholder or an exporter in many cases the ability to trade safely with an underwriter's knowledge. So we'll assess their customers in various countries and risk assess those as to what would be provided as a credit limit. And the normality of our transactions are 99% of them will be on an open account basis. So we are quite ballsy in the markets that we go to. So there's various countries in the news at the moment, Turkey being one of them. We offer open accounts over there. And other emerging markets within Africa and South America. So it really supplements credit management processes that are already ongoing and gives confidence to exporters to know that having a credit limit in place and trading in the right way, if they're not paid, then we can help them to either gain payment or we make an indemnity payment to them so that they can receive the monies, the funds that they're due.
Excellent. Thanks very much. We're just going to close with a little Brexit impact assessment. we published a white paper prior to the Brexit vote, which was to do with enforcement of judgments across Europe, so European enforcement orders, and we sort of hypothesised on what might happen if we were to exit the EU. That is now going to happen, so I guess that becomes a very real question. If anybody needs that, then please feel free to email, and we'll drop over a copy of that white paper. But really, just the Brexit impact, what's happened very recently, and this news is is changing every day. But the first official estimate of GDP growth will happen in the third quarter, so we won't really know how Brexit impacts the British growth until late October. The Bank of England has signalled that it will be willing to provide what I suppose you'd term quantitative easing in early August to try and head off this path of lower growth. Interestingly, we found some details of a GfK poll on consumer confidence. So a lot of people feel that consumer confidence is the forerunner, is a real prior measure of growth, and the GfK poll suggested or recorded one of the biggest falls in its history. So falling by 8 points to -9 in just a few weeks before and after the referendum result, and the last time a fall of that size was recorded was in the 1990s. Guys, any thoughts on that? I mean, for fear of asking your political stance on Brexit, what do you think the outcome will be for the UK perhaps in the next 6 to 12 months?
I think, frankly, it's almost impossible to tell at the moment. They're going to show the GDP growth for the third quarter, but I can't see that the Brexit vote will have made a huge amount of difference to the outcome of that. I think it would have been what it would have been regardless of the vote. In terms of moving forward, it is almost, I would say it really is frankly impossible to tell what is going to happen. As you've already stated, the situation seems to be changing practically by the day, and we don't know what sort of deal we're going to be able to negotiate. We don't know what sort of deal our partners in the EU are going to give us. But also, I think that one of the things that seems to be getting forgotten quite often is that we are still very much in the EU, and we are going to be in the EU for at least, I would suspect, 2.5 to 3 years, even if we were to trigger Article 50 right now. I just noticed today there's a court case being held in London, which is a high court case, which asks whether Theresa May actually has the power to trigger Article 50 or whether she needs parliamentary approval. Now, how long is that court case going to take, and how long is that going to delay the whole triggering of Article 50? And just looking at it from a macroeconomic perspective, we generally speaking, the normal economic cycle gives you a recession every 6, 7, 8 years or so. Now, if we suddenly find ourselves in a normal economic cycle and we are involved in a recession in the next year, which will take another year stroke 18 months to pull out of, would anybody realistically want to trigger Article 50 during that period? So, we could be looking at the next general election before anything's happened, and that will throw everything back into uncertainty. So quite frankly, I'm afraid I'm going to have to reset the fence here and say I don't really know, and I don't see how anybody really can know what is going to happen.
Okay, fair enough. Just some stats from how Brexit has affected the Eurozone. So earlier this month, the IMF downgraded the Eurozone's economic growth forecast to 1.6% for this year and 1.4% for next year. That is a relatively slight downgrade, but and you might say even a correction that may or may not have happened with or without Brexit. But it certainly shows you know, some downward pressure on those expectations, and those were based on the UK and the EU reaching a favourable deal, something approaching what's being called either the Norway Plus or Norway Minus model. Guys, what do you? I mean, it'd be great to get some feedback from everybody out there. So you're welcome to chat whilst we just cover off this very final question. What does the panel feel about the UK's chances of reaching either a Norway Plus or Norway Minus deal? So something that keeps us in the European Economic Area.
Well, I think first thing has to be said is that nobody voted for Norway. Whether you were an inner or an outer, I certainly don't think anybody actually, that was something that nobody ever voted for. So it's interesting that all economic forecasts are based on the Norway model. Now, again, it all depends on what we can negotiate and what we wish to negotiate. It's up in the air, in my opinion.
So that's the IMF saying, you know, if you achieve a Norway model, this is what we think your growth forecast will look like, and we really don't know what that forecast would be like if they hadn't. But anyway, I mean some interesting numbers there, and as you say, Hal, I think we'll probably have to see how it plays out, and it might be several months or even years before we you know, we can look back at it with any confidence and say good thing or bad thing.
I think we're looking more years, more years than months, I think.
It's interesting to see that with Theresa May now at the helm, that she's also appointed Brexiteers to the government. So it's going to be very interesting times to what they try and negotiate based on now we're very much an exporter and financial services and what we can agree. So it's going to be very interesting to see what happens over the coming, really, I think, forthcoming 12 months, because are they going to be under pressure to put a general election to the public? Are there only going to be any issues they want to put to, you know, back to the public again? So very interesting times, and it's very hard to predict. But as Hal said, I don't remember anyone mentioning the Norway, you know, in their the way they put forward to stay in or to remain or go.
Okay, well, thank you very much. Thanks for all of your comments and everything that you've given us today in terms of insight. So thank you to Lauren, Hal, and to Fergal, and thank you all for listening. Look forward to welcoming you to another event in the near future. We'll be posting a recording of this webinar on Moreton Smith's YouTube channel in due course. If anybody needs a copy of it, please feel free to ask us for it. Thank you very much. Have a good day.